Philip, welcome to the show. You obviously have to keep an eye far more on Europe at the moment than you do on Africa.
That's right, and really that's been the case for the last couple of years. There is a long-term issue in Europe, which is the level of both public and private debt is too high, and it will reduce over many years, and I think that's going to lead to low growth in Europe relative to other markets. But what's really been a focus of my attention as a CFO, and I'm sure it has been for CFOs across Europe, is the short-term issue, the uncertainty around liquidity in banks and bank capital. And hopefully, the announcement that came out in the early hours of this morning, as it's built out over the coming weeks and months, will help bring some confidence back to those key issues.
Philip, what's your sense of this announcement? Because for the past few weeks, every little signal, every bone that's been read, every tea leaf, if you like, there's been a reaction, positive, negative, pessimism, optimism. Is this different in your sense of the way these things work, joint announcements by lots of politicians and what are called leaders?
It's always difficult to judge on the first day. As you say, this is one of a number of summits over the last couple of years with promises and commitments to concerted action. The markets usually respond well, as I think they have in Europe today, and often they fall back in the following days and weeks as the detail either emerges or doesn't. So I'll judge this one really over the course of July and then the summer, if we see the real detail of what's promised in terms of, for example, single bank regulation, as we see the detail of it develop. But I have to say, from reading the announcement this morning, I think there is some promise to it that we haven't had before.
Now, what about the returns of pension and provident funds in Africa, relying on global conditions and investments in many ways? I mentioned in the introduction that you're looking at low or even negative growth, which may be all right for a company for a while, but if it's your pension money and you end up with less than you put in, which is putting it extremely, you have a reputational problem.
I do accept that these are challenging times. But I believe that equity investors, whether they're investing directly or they're investing their pension assets, do need to look at patterns over a much longer period of time. And I do genuinely believe that there are opportunities for investors in the current climate. But what's really important, given the volatility that we've seen now really for 4 years, since the collapse of Lehman's and all of those events back in 2008, it's been a characteristic of stock markets that you see large positive and negative swings day after day after day. So what I think is important for investors to think about is the opportunities that come from regular investment, not trying to judge the market, not trying to time the market, but just recognizing that over a long-term, 5, 10-year and beyond horizon, these are good times, in my view, to be investing, because from a kind of dollar cost averaging point of view, over time, returns should be there.
Thank you to Philip. That was Philip Broadley, Chief Finance Officer at Old Mutual.